Hello, Maverick traders. Welcome back to your market roundup for September 20th. Corey here with you. Let's get to this week's event. This week, it's all going to be centered around the Fed meeting, that FOMC statement, even more than the rate hikes. I think I'm personally fully expecting 75 basis points. Could they go a full 1%? Possible, not likely in my view. But as they raise by 75 basis points, it's more about the future guidance. It's more about what's in their statement. And that is, without question, the big event this week. Let's look at how today went. A little better than last week. When I did the market roundup 1 week ago, I think markets were down about 4% on the day. This week, we're only down 1% on the day. Of course, you go down 1% every day. That's not going to be very good, but certainly a softer market. You'll see that when we get to the heat map, where it was primarily in the red. Advancers versus decliners, almost 80% of the stocks going down today, and we're in a bear market. We've talked about that. 3/4 of all stocks below their 50-period moving average. And importantly, since last week, we've broken down through the uptrend lines. A lot has happened, but we'll look at that in the charts. We're in a bear market and the short-term trend has turned bearish. Now, as we look at daily news, short-term treasury bond yields at near 4%. That is a high percentage rate. And everything in the financial markets is a comparison. What can I get for my money? And right now, a quote-unquote risk-free return is at 4%. Now, this kind of speaks to how your banks are ripping you off. If they're paying you next to nothing in your savings accounts, you could invest in short-term 2-year treasury bonds backed by the U.S. government, never defaulted. In Wall Street lingo, they're called risk-free rate of return, and get 4% on your money. So when yields are at 4% for a short-term bond, that tells you that there's some problems in the system, right? That there is some risk there, that this is abnormal. This is the highest it's been in 15 years. You know, these are not your average everyday markets. Markets are very anxious ahead of the Fed meeting. What will Fed Chair Powell say? Will they give any indication that they're going to kind of back off at this point? Any sort of guidance that suggests that they're going to push the brake instead of the gas full steam ahead, like they've been talking, at just battling inflation and kind of the economy be damned, we're going to get inflation under control. If they stay on that message, the markets are probably going to be disappointed by that news. Now, this is the chart, and like I talked about last week, to me, this is the obvious kind of, okay, if and when this breaks, we're now realigned in terms of the trend. So we went through this correction. We had been in a kind of consolidation pattern. I personally was not sucked in by this rally. I said, hey, we're still in a bear market. We're below a 50-week moving average, below the 50-day moving average, whatever you use as kind of your long-term gauge. We were still in a bear market, but we had a nice bullish short-term correction that took us to the top of the range. We came down to the bottom of the range. We bounced. It was still my personal opinion that we were going to leave this channel to the downside, that the bear market would persist. And remember, the average bear market is 1 to 2 years in duration. So we're not even a full year yet in this bear market. We probably have more wood to chop on the downside. Certainly seems like that we're going to go down towards those lows in the coming weeks ahead. So you're going to get some rallies. You're going to get some impressive rallies, you know, some 1 and 2 day rallies where it's kind of knock your socks off. Wow, look at how much we've gone up. But those usually follow large declines. So even when they happen, it would be like, you know, imagine that we go up sharply on the Fed meeting tomorrow and a big green candle. Are we out of the woods? No, we're still making lower highs and lower lows. We're still below this uptrend line. We'd still have a number of problems. And that's the thing, is you kind of in the sell the rally mode because the bear market persists. It's no different in the NASDAQ. We broke that trend line, and we broke that trend line fairly early last week. And from there, it's just going to continue to kind of persist to the downside. So we've gone down a few points from where we broke the trend line. We're probably going down quite a bit more towards that prior low, but it won't go in a straight line. There will be the zigs and the zags, and the mentality, I think, is to sell the rips, sell the rallies, look at opportunities to play more bearish and have a little bit more of that focus in my view. Now, as we look at the heat map, energy was actually the best performing sector today, although it was still in the red. So it was kind of flat, actually. It was about down, I think, 0.3% or something. So it held up relatively well. You can see aerospace and defense was a green area there. So if you're looking for a little industry that was better, that aerospace and defense industry. And then Apple had the best day of the bunch. That kind of tells you that the markets would have been a whole lot worse had it not been for Apple, because Apple is a big component in the NASDAQ 100 and the S&P. So there were most of stocks going down, but Apple held up, and that kept the indexes from looking a little uglier in terms of total percentage losses. For this week and the monthly outlook, I mean, you have to kind of lean bearishly. That's what everything is kind of pointing towards. The fundamentals, the technicals, everything kind of lines up towards more pressure on the downside. Tomorrow's trading is going to be a mess. I don't know that I have a strong opinion for tomorrow. I would just kind of say, as far as tomorrow goes, if we rally, it's probably a selling opportunity. If we sell off, it's probably a selling opportunity. I think one way or the other, we're probably still going to test some lower prices. So let's look at a few different names. I've got a few up here on the bulls and a few down here on the bears. On the bullish side, it's hard for me to not continue to look at energy. It's the strongest sector year to date. It's holding up relatively well. So nothing's been spared over the past few weeks, but look at something like Apache, which is still in more of an ascending triangle type of pattern. You could call this a little mini cup and handle type of pattern. Energy holding up relatively well, and that makes sense. They're the only sector that really has good revenue and good earnings growth year over year and such. So Apache could be considered as a potential buy candidate. Lululemon pulled back to the prior breakout point. We actually had this one and suggested, hey, if it pulls back here and gives a setup, this is where we would consider it. And we are right here, right now this week, could be a nice opportunity. Notice above the moving averages, trending higher when everything else is declining. Also like PayPal. PayPal, this was the breakout zone. This area here, I didn't draw that line very well, but that 90 area where we broke out above, and now we've kind of been in this little consolidation, what we call a bull flag pattern. See the flag, and this would be the flag pull. So you zoom up, and then you have a little bit of a downward sloping, but see how it's not breaking down. It's still above the 50 period moving average. This should be right where it starts to take off to the upside. PayPal is one of my favorite charts out there. Kind of a really clean looking bull flag. Now it would have to start to move higher. It would have to start to pivot to the upside. But that one looks kind of interesting. And then last but not least, Uber, which again, I really like these types of patterns where you have a bit of a consolidation period. A lot of people worry that this is starting to break down, but usually it's more of a cup and then a little handle here, and then it keeps working its way higher. If you wanted to call this an ascending triangle, ascending triangles and cup and handles, they often have a similar look and feel and ultimately a similar outcome, which is higher prices, right? On the bearish side, IBM, we're down here at a level that it has bounced off of on multiple occasions. Descending triangles are bearish, lower highs, lower lows are bearish, etc. And it certainly seems like the path of least resistance is going to take us below that level of support. So they're trying to hold here. They're trying to hold, but the more times you knock on this door, the more apt it is to open. And in this case, it would be a trap door. You'd start to fall to the downside. Meta has broken down. This is the artist formerly known as Facebook. And similar to where IBM was, knocking on the door, it eventually breaks, right? Meta's already broken down. So I wouldn't mind seeing a small bounce, but on a small bounce, I would still be looking to short or be bearish on that type of chart. It's at new lows, new 52-week lows, new multi-year lows. I mean, when you really think about it, that's the most bearish thing possible, is it just keeps tanking and going to lower prices. And then Vmware, I actually talked about this one a few weeks ago, and it was at higher prices as a bearish candidate. Sometimes I'll play these special situations. Now, Vmware is getting bought out by Broadcom, but it's a stock and cash deal. So where Broadcom's shares go has an impact on VMware, which is pulling it down. And there's also a lot of uncertainties in the market, and there's still that risk that this deal doesn't go through in the first place. So there's a lot of possibilities here for the stock to trade lower. Now, I get it. It's already down, 5 points or something from where we highlighted it the first time. So it's a little later, maybe not as good a risk to reward, but these options, because it's expected to flatline, usually when a company's getting bought out, the volatility shrinks and you'll see a stock just start to flatline to a certain extent. Well, the options market is kind of pricing in a bit of a flat line, like not expecting too much volatility, which is kind of good because you can buy some of these out of the money put spreads where you target a downside move, and you can put on a $5 spread for less than $1 or around $1 total cost. So you really get those good 4-to-1 type of reward to risk ratios, and that sort of thing on a vertical spread could be interesting. The biggest concern is less liquidity in the options. There's not a ton of trading happening, so you've got wider bid-ask spread, so you really have to be careful with your orders. Always use limit orders and just make sure you get a great price if you're considering it. Now, markets are still in a bear market. I've had this up for a couple of months now. Just a reminder that we're operating in an overall bear market. Now we've broken the uptrend line, and short-term trends are down, intermediate-term trends are down, long-term trends are down. You're probably going to continue to trade lower for a while. That's most likely. It's not a given, it's not guaranteed, but that's my view. FOMC meeting tomorrow, and then on the earnings front, we're back to, last week was really quiet. This week we've got some companies reporting, Costco and FedEx and General Mills and Lennar and Stitch Fix and so forth. There are some actual earnings to look at and potential stocks that you could trade through earnings if that's your jam. So thanks everyone for being here today. Hope you enjoyed the market roundup. On behalf of Maverick Trading, I'm Corey Halliday. We'll see you next time. Goodbye, everyone.